Good evening, everyone. My name is Nikita Kostikov. I'm a part of the called Corporate Taxation. It's an MBA course from Concordia, section 657. Our instructor is Dr. David Bovin, and the topic of the paper that we have submitted last week, which is the final paper, called Ethical Accounting. And within the ethical accounting paper, we had to pick a corporation. Uh, and my corporation that I picked was Coca-Cola Company. And we had to explain why uh, that was the pick in terms of tax and financial accounting implications. So Coca-Cola Company is obviously a beverage company that was incorporated on September 5th, 1919, and now a leader in marketing, manufacturing, distributing of non-alcoholic beverage drinks and syrups also all over the world. It also has product lines, a vast number of franchisees, and bottling partners all over the world. It does chain distribution, offers ingredients to wholesalers, canning, bottling operators, and retailers. Uh, the most famous brands are Minute Maid, Aquarius, Diet Coke, Gold Peak, Powerade, Dasani, Fanta, Sprite, and many more. So the ethics of the company like Coca-Cola depends a lot on how do they approach tax avoidance, because there is a huge difference between tax avoidance and tax evasion, like we learned in our textbook. Because tax evasion, it's basically a fraud, theft, or corruption, which is both unethical and illegal, and penalties and interest may apply to the taxpayer when tax liability is understated. For example, filing after due date, understating gross income amounts, and underpaying withholding or estimated taxes that are due. And the company will eventually get in trouble from IRS, obviously. So um, the topics that I focused on in this paper was applying income taxes and financial statement, um, especially how did the Tax Reform Act in 2017 affected the company. Um, because the company was required to pay a tax on historical offshore earnings that have not been repatriated to the United States. So that could be affected generally. And as a result of this reform, Coca-Cola recorded a 15% net operating revenue decline, and also operating income was down 13% to $7.5 billion, which resulted in the company's unit volumes of soft drinks decreasing by 1%. Um, However, the chief financial officer, Kathy Waller, she said that the new tax law will enhance the ability of U.S. Headquartered companies like Coca-Cola, which is headquartering in Atlanta, Georgia, since its origins, uh, to compete globally on more equal footing and better enabled to reinvest in the U.S. business system. Um, So another concern regarding that tax act from Coca-Cola and the U.S. based companies like Coca-Cola was the switch from the worldwide tax system the to the modified territorial system that the rest of the world was on. Basically, it um, eliminated the advantage that the I would say, no, not the advantage, the disadvantage that the U.S. based company had, and put it on the equal footing with global competition, uh, which means the corporation had to pay taxes on income where it is generated and can repatriate those earnings uh, without incurring further tax, right? So also I have about the concepts like tax concept of gross income. Oh, another thing was the tangible assets amortization and deductions, and how did that apply to Coca-Cola, since Coca-Cola's intangible assets for the quarter ended in December 8, 2018 was 17.2 million, and the corporation carried 27.9 billion of goodwill and other intangibles on its balance sheet. So in order to determine whether the goodwill is excessive or not, tangible assets ratio will show the percentage of total assets made up by goodwill and other intangibles. Um, and we figured out during the research that 33% of uh, intangible assets ratio that Coca-Cola had was because of the reason that management was most likely overpaying for the acquisition or acquisitions that gave rise to the goodwill. The impact of net operating loss on taxable income is very important because Coca-Cola company had 4.3 million of loss carry forwards available to reduce future taxable income, as the loss carry forwards of $331 million must be utilized within the next 5 years. And that was back in 2016. So, and the company's deferred tax asset evaluation allowance is primarily a result of these uncertainties regarding the future realization of recorded tax benefits on tax loss carry forwards from operations in different jurisdictions and globally as well. Also in the paper, I discussed tax treatment of capital gains and losses for corporate taxpayers. Coca-Cola's total stockholders' equity equaled 25.7 billion back in 2016. Also, Coca-Cola had a market capitalization approximately $187 billion as of August 8, 2016. That's currently the biggest in the industry. However, Coca-Cola's liabilities have grown by 21%, which actually helped them manage through the corporate taxation. And yeah, sorry about that. And also we went through tax reporting process for corporations step by step. I'm not going to mention it now, but it involves filing schedules M1 of Form 1120, M2, and also M3 schedules. It's very, very much described, very, I would say, detailed in my paper. And also, since Coca-Cola does file Form 10K with the Security and Exchange Committee, the Schedule M3 automatically applies. One thing I wanted to talk about is why did I pick the company? Because Coca-Cola was recently facing ethical issues and allegations of how they treated workers in India and South Africa especially. And also in terms of taxes, the company was faced by an IRS bill of $3.3 billion for back taxes. The IRS contended the audit from 2017 to 2009, and it has stated that several foreign affiliates' royalties were too low during that time from Coca-Cola, which reduced the parent company's U.S. income and resulted in the underpayment of the U.S. income tax exactly by $3.3 billion. However, the corporation, Coca-Cola, thought that they had a deal with Internal Revenue Services back in 1996. That's why they have sued them back, and that's why the trial is still going. So there is no really a definition of who's going to get it or, who's going to win the trial. So they're still battling for it. However, the company's officials said that if the IRS would win the trial, it could significantly impact the company's financial position of how they operate their financials and cash flow as well. Because transfer pricing is under more scrutiny than ever before from tax agency right now, especially for the global corporations like Coca-Cola, due to new strict global standards, which raise legal risks for companies and their investors, and obviously their shareholders. Basically, Coca-Cola went on the trial as interest among many corporations seeking, I would say, multi-year deals with the IRS covering transfer pricing arrangements that has fallen the past 2 years. Overall, all the points provided in the analysis above, as well as final recommendations, I think would help Coca-Cola to reach targeted mark of 35% operating margin by 2020, or even earlier, as once again the company's recent refranchising in the United States will provide most of the financial improvement, margin improvement, ethical profitability, and overall wellness to the company. The refranchising is the important aspect here because in North America they have done it recently and it will increase the margin. and increase the cash flow, which will definitely be a huge benefit for a company like Coca-Cola in terms of financial reporting and accounting ethics. A high free cash flow conversion rate is credible goal for a company like Coca-Cola, and they definitely enjoy a certain amount of recurring volume as a global leader. So to hit a high benchmark on this quote, the company has to ensure the different sections of the profit and loss statement, balance sheet, statement of cash flows should be all optimized, right? All in all, the risk still is pretty high. However, if Coca-Cola relies on bottling partners' financial deterioration of the financial condition or results of operation, that could adversely affect net operating revenue. It will decrease the income equity and negatively affect the carrying values of investment, which will result in asset write-offs. The growth of current ratio increased in current assets and decreased in current liabilities from 2017 to 2018, which would potentially suggest that Coca-Cola has inferior payment conditions for accounts payable compared to payments conditions for accounts receivable, so that auditors should focus on more accounts payable. Overall, Coca-Cola has managed to keep their financials and accounting reporting tight, despite of that bill faced from IRS. However, I would recommend the company, from after the research that I did, is to keep their ethics, I would say management ethics and accounting ethics tight as well, and do a little thorough audit, because that affects the way consumer sees the product. Even though we would think, why, I would still go buy a Coke. No, the majority, I would say, according to the recent research, 75% of the people actually care about how the brand treats their employees, whether they're abusing something or they're involved in some kind of again trial. They would actually care about that. Thank you, and please let me know if you have any questions, because I tried to go short. However, the video might be a little too long. Thank you again.